How we doing, class? Put some 111s in the chat if you can hear me okay. We're going to get started here in literally moments. Put some ones in the chat that you can hear me okay. And let us know in the chat box where you are tuning in from. All righty, ladies and gentlemen, welcome to another YouTube live stream. Super excited to be here. As you guys know, or maybe you don't know, maybe it's your first stream back. I'm making it a point to be in front of my computer, in front of my audience, absolutely free, right here on YouTube. All you guys have to do is click that like button to keep me doing these. And the second thing, all you have to do is, of course, subscribe and turn on that notification bell. We are getting extremely close to 30,000 subscribers, so thank you guys for that, and make sure you guys click that subscribe button. Today's topic is the one indicator that has had a 100% track record of predicting recessions in the United States. Now, this spans back till approximately 1960, and that's what we're going to spend today talking about. I don't like the recession word, the R word. I don't love talking about recessions because, let's be honest, generally speaking, it's a buzzword, it's a keyword, it's something to get people panicked and fearful, and it's used to engage in clicks and get article clicks and get the news more clicks, and everybody wants to know the question, are we in a recession? Now, first and foremost, I must tell you guys that the way that a recession is determined has changed from the past till it is today. Nowadays, we have to have a declaration of a recession. What this means is we literally have to be declared in a recession. In years past, decades ago, what we had happen was very simple. Did we have negative GDP for multiple quarters in a row? Yes or no, black and white, we're in a recession. Nowadays, it's not that simple. Nowadays, we must be told we are in a recession, and let's be honest with ourselves. They don't declare us in a recession until after we're generally out of a recession. And so it's up to us as human beings to do our own due diligence and study whether or not we're actually in a recession. And so today I'm going to introduce to you guys the one statistic, the one indicator that has predicted all of the past recessions. And guess what? It has just predicted another one. And so, as you guys know, we always say past results don't guarantee future results. The past doesn't guarantee the future. So that is as clear as day here. History is meant to be broken. But whenever I look at something and it has an 80, 90, or even 100% in this case track record of predicting recessionary environments, I think it's important to share it with my audience so they at least see this and they learn about it. And so today I'm going to introduce to you guys what's called the SOM rule. Yes or no in the chat box, guys, if you're joining me on this live stream, if you're watching this on recording as well in the comments section, yes or no in the chat box if you've ever heard SAHM of the SOM rule. SAHM. How many of you guys have heard about the SOM rule? Yes or no in the chat box. Now, what is the SOM rule? The SOM rule predicts a recession when 3 months of the moving average of the national unemployment rate. So we take the average of the last 3 months of the unemployment rate in the U.S., and over those span of time, if it raises 0.5% in a given year, 12 months rolling window, it predicts we have a recession or we are already in one. Let me say it one more time. The 3-month average unemployment rate, if it rises by 0.5% in any span of 12 months, we are in a recession or a recession is coming. So what I want to do with you guys is just briefly show you where we're at And then I want to go back and show you what this chart means. So let's zoom in really quick to where we are currently at. Let's go right up into here. As you can see, January of 2024, what were we at? 0.2. February, 0.27. March, 0.30. You get the drill. And by the way, you guys can go find this, the exact chart I'm on, by going right there. Okay? Hang on one second. Now, when you go to that link, what it'll show you is that percentage. September and October and November and December and January and February. So zoom out just a tad. What did we see last August? 0.13. Where are we at now? 0.53. August, 0.13. We're now at 0.53. And as this continues to trend higher, we get sharper and sharper into this zone of unemployment being spiked. So, let me go back. What does this chart really mean? See these gray shaded areas? Every time you see a gray shaded area, that is a time of a recessionary environment. The last little gray shaded area, of course, was COVID. Before that was the Great Recession of '08. Then we had the dot-com bubble. The list goes on. What you guys can start to do on this link is you can start to zoom in on all of these times. And what do you notice, whether it be slightly before, like you see right here, before, or during, what do you notice on all of these times? What do you all notice? You'll notice a sharp increase of the unemployment rate. Now, why this is important, guys, is Jerome Powell, the chair of the Fed. He has mentioned dozens of times, that the labor market in particular is something that they are going to continue to watch without question. And so the labor market, as you know, is the number one reason why the Fed is going to get scared, whether they're going to cut rates, whether they're not going to cut rates. Obviously, right now we have a 100% chance that they cut rates in September. On the flip side, as you know, I mean, you can't go anywhere right now. All of you know this. You can't go search the SOM rule. You can't go to CNBC, Business Insider, Bloomberg, Seeking Alpha, CBS News, Market Watch. You can't go anywhere without hearing about the SOM rule. The SOM rule is officially triggered. We are above 0.5%. Now, what I found interesting, let me go back to the link I had open. Oops. Was I found this article. This is Claudia Sahm, the creator of the SOM rule. And you guys are saying it's not clear. I think you can edit the quality because I'm streaming it at HD. I found this article interesting. So this is the creator. That's her face. This is her name, Claudia Sahm. She created this idea that if we see this number come up above 0.5%, that we are headed to a recession. Every time this comes above 0.5%, which, by the way, to give you guys a visual, I know this isn't going to be perfect by any stretch. If you look at this, let's edit this in Paint. What you have to visualize is basically halfway between 1 and 0. That's what you have to do. Just to give your eyes a snapshot, okay? It gives you an idea. Did we cross above it? Yes. Were we in recession? Yes. Did we cross above it? Yes. Were we in recession? Yes. Did we cross above it? Yes. Were we in a recession? Yes. The list goes on over and over and over and over and over again. Notice this chart, simply put, does not cross above. It just did here. It does not cross above any of the time after the Great Recession, 2010, 2011, 2012, 2015. It sticks low. Between the dot-com bubble and the Great Recession, it tries, and then it sticks low. Down here, it sticks low. It doesn't, and then suddenly, what just happened recently? It goes above. But, as you guys know, I like to look at both sides of the story. So, I saw this article come across, and I'm like, wow, the creator of this rule, the creator of the person that created this rule, that has predicted all of the past recessions, says, I'm frustrated because she doesn't believe that we're headed into a recession. I thought that was interesting. And so what I started to do was read. And actually, this is the other chart I wanted to show you guys here. Go click this link too. Can you guys click links? I don't know if you can click links on YouTube. I don't even know. Let me know if you can click links. Let me know if you guys can click links. By the way, if you're watching this on a YouTube recording, the reason I'm talking is because we're currently live. Make sure you join my live streams on my channel. If you have not subscribed on this channel yet, you got to subscribe to get the notification of me going live. Currently, we've got over 50 people live on this stream. So here it is. If I snapshot this, you guys can now just grab the link and scroll down here. But this is truly a interactive link that lets you see, as you can see here, it lets you see where 0.5 is. Now, the reason that's crucial and critical is it allows you to look back in history at all of the times, and you can draw across. So notice we got to 0.47 in August of 2003. Almost, but didn't get there. But now we're at 0.53. Getting above that 0.5, I hope you all understand this by now. Getting above that 0.5 on this 3-year month moving average. 3-month moving average, excuse me, not 3-year month. 3-month moving average. Getting above that 0.5 has predicted all of the past recessions since 1960 when they started tracking this data. They weren't tracking the data before, so it'd be interesting to know what it was. But let's zoom back this out. You guys can go play with that all you want. I just wanted to show you where it is. A false positive. Psalm says that the supply side of the unemployment equation is the Achilles heel of our indicator. And the rising labor force participation is the reason it is producing a recession signal, despite her belief that the economy is not in a downturn. The pandemic has upended labor market dynamics, and current job growth and consumer spending have not yet deteriorated enough to show signs of a recession. She said, the pandemic cycle has been different on so many dimensions and has laid waste to so many economic models and rules of them. Psalm said in another interview on Wednesday, if the Psalm rule was going to fail, it's going to be this time. Another thing she said is maybe you can't do early stage recessions in a reliable way, and maybe the cost of getting people very concerned outweighs the benefit. Now the question becomes this. We all have to always know there's two sides to every story. So the question is there merit to this opinion? Or is this the first time in history that the Psalm rule has gotten as much media coverage as it's gotten? And she is trying to basically avoid panic. And she's also trying to avoid what? Humiliation, if it's right or if it's wrong. She's trying to say, hey, I think it might be wrong. Is that what she's trying to do? Or not? Now, I want to explain to you, first of all, that take the Psalm rule out of it. We're not talking about it for just a minute. The probability of a 25 basis point cut on September 18th is 48.5%. The probability of a 50 basis point cut on September 18th is 51.5%. So we know right now that we have statistically on September 18th of 2024 a 100% chance of cutting rates at least 25 basis points. We have a better chance of cutting rates 50 basis points. Now, there's only three options that the Fed has as we speak, as you all know. There's only three options. Option number one is they cut rates. Option two is holding rates. Option three is raising rates. Now, the reason that I'm nervous right now is fairly simple. If you guys remember on Monday, the reason the market deteriorated as fast as it deteriorated, not necessarily in the U.S., but more of a global market pressure in Japan and elsewhere. We saw some of the worst days since 2008. The reason we saw that was to do with, of course, the carry trade. Bitcoin fell, stocks fell. Of course, the bond market spiked and yields fell. Japanese markets fell. South Korea's markets fell, worst day since 1987. Commodity markets fell. The reason was to do with the carry trade, and you guys can visit back on my channel. I have a live stream as well as a video describing exactly why that happened. But when we talk about a carry trade, the real instance of a carry trade and the real reason it's painful isn't necessarily to do with a rate change. It's actually to do with a conversion of currency, specifically to do with the dollar against the yen. See, the pain in this was that the value of the yen rose against the value of the dollar right here. When dollar-yen drops, it means the yen's getting stronger than the dollar. And so what did this effectively do? Well, effectively, it made it more expensive in dollar terms to convert the currency back to the yen in the quote-unquote carry trade. So that's the first starting point. But now we were talking about what are the three things that the Fed can do. And I mentioned the 100% chance right now. What is the Fed going to do? They're going to cut rates. So, if they are going to cut rates, what does that do to the value of a currency? Think about it for a moment if you don't know this answer. When you cut rates, it makes interest rates on mortgages lower, car loans lower, personal loans lower, boat loans, RV loans, whatever. It makes it lower. Are you more or less inclined to borrow money at lower rates? We saw this happen in 2020. Heck, this house I'm sitting in, I borrowed at 2.65%. I was much more inclined to buy a house in 2020 and 2021 than I am now. Not only because the price has gone up, but because I was able to borrow money at 2.65%. So we're more inclined to borrow money at lower rates. We all know that. And if I borrow money, what does that do to money supply? See, a lot of people don't realize this, but it increases the supply of money. You're turning on the money printer by lowering rates. And when you increase supply of an asset, if I were to tell all of you today that they just found in Mount Everest more gold than they knew existed on the planet, what would happen to the price of gold? It would go down. If I told you today that they found a brand new massive pocket under the ocean of oil that is said to allow us unlimited oil for the next 1,000 years based off of our current consumption, what would happen to the price of oil? It would go down. If magically Bitcoin, they found another 50 trillion Bitcoin, what would happen to the value of Bitcoin? It would go down. See, guys, when we lower interest rates, when we cut rates, when the Fed cuts rates, the Fed funds rate, they are effectively lowering interest rates, which entices all of you to borrow more money, which increases supply, which is what we just talked about, which diminishes value. When you diminish value of the dollar, What direction does this chart go? Does it go up or down? Does it go up or down, UJ, when the value of the dollar diminishes? UJ goes down. Now let me backtrack. Take all the fancy terms, economical terms, I don't care. Take all of it out of it. What direction did UJ have to go in order for that market on Monday to absolutely unravel? What direction did this chart go? Down. This was actually the last of it on Monday, right here. It went down on Friday, which we were seeing pain on Friday, and then again on Monday. It went down. When we cut rates, we understand this is going to increase the value, increase the supply of the USD, which hurts the value, which puts stress to the downside on this chart, which puts more stress on the carry trade. Because believe me, the carry trade is not over. The liquidation did not end. And so this is why when we talk about the Fed has three options, when they cut rates, after rate cuts, I'm not saying the same day, I'm saying in general, I think that can be seen as a bad thing in the markets. It can put stress on the markets. A lot of people think, oh, when rate cuts come, we're all going to be fine. Woo, hallelujah. I would say use caution. However, unemployment, is it getting better or worse? We spent the first 25 minutes of today's session talking about the SOM rule. Is unemployment getting better or worse? It's getting worse. So holding rates at current levels is going to only accentuate this problem and maybe make it worse and give us a higher risk of a recession. So we probably don't want to hold rates. So wait a minute. We're probably screwed if we cut rates. If we hold rates, it puts more stress on the economy because it consistently holds that stress. Retail sales down, unemployment getting worse. So that puts stress on the economy. And would we want to raise rates? That's a 0% chance. Definitely not, because inflation's already falling, retail sales are dwindling, and unemployment's getting worse. So you can't do that. So wait a minute. You can't raise rates. That's going to make things way worse. If you hold rates, it's going to put more pressure than the economy already has. Expectations of the public are, what are we going to do? We're going to cut rates. So if you held rates, it would send, all hell would break loose. So you can't do that. But if you cut rates, yeah, it's going to be perceived as a good thing, but it's going to make the carry trade worse, which could unravel a liquidity cascade and cause a massive sell-off in the market as well. Oh my gosh, the Fed is stuck between a rock and a hard place. Listen, the Fed is sitting here and they've got a knob. They've got like a keyboard. They're in like a sci-fi movie. They've only got three options. Option 1 is cut rates. Option 2 is hold rates. Option 3 is raise rates. Not going to raise rates. Could they hold rates? Sure, but the unemployment level is already going up. Inflation is already dropping and retail sales are dwindling. So we probably don't want to do that, but if we cut rates, it's probably going to accentuate the carry trade, which puts stress on certain markets because of liquidation, which causes sell-off in the market, which causes more panic, which causes them to have to cut rates even more. We're in an interesting position, and if you guys think that the carry trade, if you think the carry trade isn't important, first of all, I want to stress how important it is, and that's why I say go back to that video. But second of all, what I do want to say is let's take the carry trade out of it. Take the carry trade out of it. If I pull up a couple stats, let me find where this was. Where was this? 40% of Americans right now are worrying about paying bills. Let me go like this. This is what's scary right now about the economy. 40% of American adults are worried about paying bills right now. That was 37% in the Great Recession. Total household debt in the U.S. has hit $17.69 trillion. That's up 1.1% from the previous quarter. Credit card debt has gone up from 1.1 to 1.2 trillion dollars. That's the highest ever. Now we have less available for emergencies. There's a 35% spike in rent evictions right now due to high rents. Rent increases peaked at 17.7% year over year in 2022, and they haven't dwindled much off of that high. We're still paying high rent costs. And guess what's even worse to me? The majority of people in America right now believe that achieving the American dream is impossible. 57% of millennials do not think it's possible to achieve the American dream. 59% of Gen Xers do not believe it's possible to achieve the American dream. 48% of Gen Zers do not believe it's possible, and 51% of baby boomers do not think it's possible to achieve the American dream. In 1971, 60% of U.S. households were in the middle class. Now it's only 51%. Why? Because the middle class is getting smaller, and those people are dropping to the lower class. And last but not least, 40% of all U.S. money was printed in 2020. Some estimates say it's high as 80%. But 40% of all the money was printed in 2020. You can't just magically erase that. So, going back to the screen, why do I mention all of this? Take the carry trade out of it. S&P 500 versus the Fed funds rate. Sorry for my typos. If I were to go into a chart here and look at this, what a lot of people fail to realize, and what a lot of people are currently celebrating, is they're getting excited about rate cuts. Here's the trouble. In 2008, right there at that black line, that is when we started cutting rates, my friends. How is that, you say? The red bars getting shorter means they're cutting rates. Notice how we haven't cut rates yet right now. They're all the same because we've been holding rates steady. When the bars start to get shorter, that means we start to cut rates, which is what we believe will happen September 18th of this year, 2024. But the blue line represents the S&P 500. The S&P 500 got higher shortly after they cut rates, just nominally. And then look what happened. That was over a 35% decline. And in a recession. That was 08. Right here, prior to COVID, they started cutting rates. The economy started getting slow. They needed to cut rates to spur up some growth. Look what happened. Again, S&P 500 went up a little bit, and then COVID hits. Over here, that's where they started cutting rates. Look what happened. Again, that was in the dot-com bubble. Look what happened to the stock market. What I'm trying to show you guys is that the public right now seems to be very excited about rate cuts. They're very bullish on rate cuts. And yes, twice out of the last 3 major economic recessions, which was, of course, the pandemic, the Great Recession, and the dot-com bubble, twice out of those 3, actually the stock market went higher short term. But all 3 times, tell me what happened. Time number 1, they started cutting rates, stock market fell. Time number 2, they started cutting rates, stock market fell. Time number 3, they started cutting rates, stock market fell. What we must realize right now is cutting rates has been a phenomenal indication over the last 20 years of markets falling, not markets being bullish. And so that is why I tell everybody, while we are going to begin cutting rates, it's like without question, you ought to be careful of where you're keeping your capital, and you ought to be in a position to hold some cash should the market have another correction similar to the last 3 times that we have cut rates. And this is not my opinion, this is simply data of what's happened the last several times. So what I'm going to do now is I'm going to zoom in here to your guys' chats and see what you guys have to say. Let me see here. So, would you say they have created this issue? Cuts could have happened sooner, I'm sure other options may have been possible at some point in time. To blame the Fed for the issue is not right. The Fed didn't cause this issue. In fact, the Fed did everything that it could by raising rates to slow down the economy. The issue came when we were giving out unemployment, when we were printing trillions of dollars, when we were sending out stimulus checks, when we were giving out PPP loans and SBA loans. The issue came then. You cannot print 40% of all money in circulation in 1 year and not expect there to be repercussions at some point. The problem is most administrations, right or left, have simply kicked the can every time they've gone in to look good for the public. Someone at some point is going to have to face that demon and say, we have to get this under control. And there's not many ways to do it other than cause immense pain for the people of the United States and the globe. And let's face it, no politician is willing to say that. So how do we know where in the recession we are at the beginning or the end? We don't know if we're in one because they haven't declared one. We don't know if we're at the beginning. We don't know if we're at the end. But what I can tell you is right now, what is the data telling us? Unemployment is rising. Retail sales are dwindling. Inflation is falling. All of these signs are saying that we are starting to enter a time of a contraction in the environment, in the economy. The question is, are we in a recessionary environment? GDP says no. GDP is still positive. And so for me personally, I actually don't think we are currently sitting in a recession, which is contrary to a lot of people's belief. I've been consistently watching GDP. The only problem is all data is what? It's lagging. It's based off the past. So we don't know exactly where we're at till the data comes out the following month or the following quarter. And that's the challenge with economics in general. Is Bitcoin a safe place if cuts happen? So long term, I think crypto, Bitcoin in general is where I'm isolating. I do think it's a safe place when cuts happen. Because when cuts happen, what happens to the value of the dollar? It goes down. See, Bitcoin tends to lose value in times of massive fear, but also in times of the dollar gaining value. So in the times of dollar losing value, that can actually be seen as a very bullish impact on Bitcoin. So I think that if you have a long-term horizon, if you have a long enough time horizon, Bitcoin can be a great place. So can stocks, so can commodities, even so can real estate. I think the people that are going to be in trouble over the next 24 months are the people that have short-term time horizons. They want to be in and out of the market in the next 2 to 3 months. And let's face it, we are facing so much uncertainty politically, geopolitically, and economically that if you're only going to be investing for a couple of months, I would stay on the sidelines as a whole. Since COVID was a black swan event, but other times, 08, .com, et cetera, wasn't, would that affect the indicators of a recession like the SOM indicator? Hesser, phenomenal question. See, Cindy Somm has said just this week that she doesn't believe her SOM indicator is producing a correct signal of a recession. She said that in an article. And so she says because of the skewed data out of COVID, because of the amount of money that was printed, there's no question that unemployment has to spike, but it doesn't necessarily show that we're contracting. And so this could be the time where the data every other time is predicting a recession, but because of the amount of money we printed and where we are currently at, it doesn't predict it this time. And that's where we as human beings just have to be aware of that and not guarantee ourselves and put ourselves in one bubble or another. Hey, we're in a recession, we're not. We have to say, okay, we just have to take this and roll with the punches as we come along right now, set a long enough time horizon for our investments, and see what happens with the data. I mean, guys, if you think a politician or a war or anything other than the fact that we printed more money than any other time in history caused this, I think you're delusional. How do you print all of this money? You give it to people via unemployment. You give it to them via PPP, SBA. By the way, sorry if I'm stepping on your toes, but I feel like most people want this to be said on the internet. Most people won't say it because they're on one side of the spectrum or another. I don't know if you guys agree with my statements. But the problem is you cannot print all of this money. You give it to businesses, and then you give it to people that are making under $140,000 a year, which is the majority of the country. You give it to them. They spend it on cell phones and trips and flights and booze and whatever they buy. That then rolls up into the pockets of the wealthiest in the world because it goes into their business. They can now expand. They can now buy more real estate. They can now buy more stocks. They can now travel more. They can buy more cars. And then you get a shortage of production in cars and houses and you name it. You can't expect all of that to not cause a massive inflation. But then here's the disgusting part. You can't expect it to be over. Right now we're dealing with an election year in the United States, and guess what they're asking these politicians? How do you plan to stop inflation? And these politicians try to act smart. Instead of saying, the fact is we printed 40% of all money in 2020. We can't possibly erase this money like poof, like a magic finger. It's going to be in the environment. And the only way to truly get inflation down is by inflation doing what? And prices down? Inflation has to go negative. Inflation sitting at zero means prices remain where they're currently at. Everybody wants inflation, prices to go down. Prices going down mean inflation actually has to go negative. That'll never happen. You know why it'll never happen? Because by the time that inflation goes negative, the Fed's going to slam rates back to zero to stir the economy up in a fabricated economy that is 2% inflation. What does 2% inflation mean? It means the economy is growing by 2% a year, so that your real estate goes up by 2% a year, minimum, so that your stocks go up by 2% a year minimum, so that your wages go up by 2% a year minimum. It's all fabricated. We cannot erase it. And so here's the gosh darn truth. We're never going to go back. Everybody wants to go back to 2019 prices. Everybody wants to go back to what it once was. You can't, because you can't erase the money that was printed. You can put pain, you can create conflict, you can raise rates and cause the poor people, unfortunately, to get hurt while the rich are on their yachts and doing their stuff. You can do all of that. But guess what? Now the economy's starting to slow down, and guess what's happening? We're kicking the can again because we're about to reduce rates again because we don't want to inflict too much because we want to maintain 2% inflation. It's tough. Sorry, but it's what's happening. We're facing the consequences, Alexandra said. Absolutely. We're facing our own music. We are facing our own music. Who else has questions? Blaming Fed's rates is an easy go-to. Oh, I'm not. You saying I'm blaming Fed rates as an easy go-to? I thought it felt the opposite. I'm not blaming Fed rates. You know who I'm blaming? Donald Trump. There you go, Fred. Who printed all the money? Who printed it? What do we call it? Trump bucks. Who acknowledged the unemployment? Who did all this? Oh, but Patrick, but he had to. Oh, now that's interesting because you guys were the same people that were saying we shouldn't be out of work. What I'm saying is the printer was turned on. The Fed had a part in it by reducing rates. But it's a double whammy. You can't print all that money and not expect repercussions. So Trump saying, oh, we need presidential input is him saying we need to reduce rates. We got to reduce rates. Okay, let's reduce rates. And let's have inflation maintain its level around 2, maybe for a year or two. And then let's what? Let's have inflation start to go back up again. And we can say we've got a great economy and it's growing again and it's this and that and the third. On the flip side, the Biden administration cannot, I'm on both sides here. I'm talking shit on both. Sorry, guys. So I'm not trying to step on any, I'm not in politics. I don't have a side. So that's why I talk crap about both sides. So hopefully you guys are okay with that. On the Biden side, what do? look at how the economy, look at how much we grew it, look at that. No shit, Sherlock. Patrick Kenny could have grown the economy. You printed because the previous administration printed so much money, and at the beginning of your administration, there was so much money being printed, and rates were literally at an all-time low. Anybody could have grown that economy. So what I'm saying is, the amount of money they printed, it's inevitable what happens. Inevitable. You can't assume that one party is going to help the other, or is going to help it versus another party, when they were literally just inherited what was given to them. That's why I advise all of you, if you're politicians, you wear the political cap. Your vote doesn't matter, by the way. We've seen that, because they can just replace it. Instead of putting the political cap on, put the economic cap on. Ask yourself, what caused this? Money printing, low rates, and lack of supply. Okay? Lack of supply, can't blame on really anybody. Money printing, you can blame on people. Low rates, you can blame on people. But you know what? We can't go back. So the question becomes, what do we do now? Well, inflation is dropping. Shout out to the Fed. I think Jerome Powell's done a phenomenal job. Because he's kept rates high, he has a massive lever to pull. We're at 5.5%. That's a massive lever. That's the best thing Jerome Powell did, was keep rates higher for longer. You know why? Because now if the economy really does go to shit, he has such a big lever to pull. He has so much room. We're not between a rock and a hard place, if you will, there, where he could drop it so fast. Yes, it would hurt the carry trade, but he could help the economy in that light. That's the good news. But the bad news is that the systemic issue is people can't afford to live. Rent increases, cost increases of homes and cars and technology and you name it, travel, I don't care. And everybody wants to say, I want prices to reduce. Well, how do prices actually go down? Like actually go down, meaning the price of this iPhone goes down. How does that happen? Inflation has to go negative. Not 2%. People tend to forget inflation's only based off the last 12 months. So inflation dropping simply means prices aren't going up as fast. It doesn't mean prices are dropping. That's the sorry part about this, is that we now, as a society, have to figure out how to survive in a new era. We have to figure out how to survive on lower wages and higher pay, or a higher cost. We have to figure out how to work more, enjoy less. We're in a brand new society that all of us are trying to figure out. And I'm sick and tired of the political games, both sides, blaming each other when we're both part of the issue, let's face it. But the real systemic issue is you cannot print the amount of money you print and expect there not to be repercussions. You will own nothing and be happy, Miranda. That's what they say. By the way, I'm on my own channel, my own page. This is my own YouTube. My name's Patrick, and I live in the United States of America where I can say what I want, and that's my right. And I hope that I'm not stepping on too many toes, but if you're offended, I'm sorry. But face it, this is how I feel. I feel like we are right now in a really interesting time. I feel right now we're not voting on who we want elected. We're voting against the other person. We're trying to avoid one, so we'll take the other. I want the American people to go, man, we've got two candidates, A and B, and I'm so excited because I like them both, but I'll go with A or I'll go with B. I would rather that be the election than, oh, man, I just can't stand so-and-so, so I'm going to vote here, even though I don't think they're going to do well either because, face it, I think that's the election we're running into, unfortunately. So as we talk about the economy, as we talk about politics, as we talk about these things, I want you guys simply to recognize that I look at things through an economic lens, not a political lens. And through that, I will probably say things against and for both parties at all times. So people that are far left are going to hate me in some moments and love me in the other, and people far right are going to hate me in some moments and love me in the other. But I hope that common sense politics, which is what I subscribe to, is okay with you guys. Appreciate the likes, guys. We're only at 28, but 62 of you guys are on here. If you could all click that like button, that'd be a lot. That'd mean a lot for me. Do you guys have any more questions? I love going live on YouTube. I haven't in quite some time, but yeah, really excited about this YouTube channel for sure. Trying to grow this thing. 29 likes. Appreciate the likes. What other questions you guys got? What are your other opinions on this? Where do you disagree with me? I'd love to hear it. Where do you agree with me? We're good. I think digital money is part of our future, but I don't honestly, I honestly am not a big enough crypto guy to even go down that rabbit hole in a way that would make sense. I own Bitcoin. That's it. That's it. Chairman Powell is and was the most consistent government official in both administrations. I'd agree. I know that some people don't like Powell. I think he's done a phenomenal job trying to tackle the most difficult economic scenario that any human being has ever had to tackle. And granted, it's the FOMC. It's not Jerome Powell. It's the Federal Open Market Committee. It's a committee of people making these collective decisions. But I do not envy the guy. I do not want to be him. He has such a difficult path, and no matter what he does, someone's pissed off. I want you to realize that. What's crazy is how we can have like 400 million Americans and get stuck with these two candidates. That's hilarious, Ryan. It's hilarious. If you had to increase your income, what's the best method? If you had to increase your income, what is the best method? Sales. Period. End of story. Go figure out how to sell someone else's product or create your own product and go sell it, whether it's a physical or digital product. Go sell, sell, sell. I believe sales cures all, and if you want to make money and get out of the rat race, you have to go sell something. What do you think could be the solution to all of this? Miranda, this is where I don't know what to say. Like, we have created such a massive hole that as far as a political leader's answer to that, I don't know how possibly they could even BS their way through the answer. As a human being, as an individual, as a citizen, as just a voter, my answer to you is out of fiat into assets. Out of fiat into assets. Make as much money as possible and get it the hell out of fiat. That's the only solution I have for you. Because the only thing that I can tell you is, in November of 2022, I bought Bitcoin at $16,500. And because of that, every $16,500 I invested, I have over 60,000. However, if I'd left that in fiat, I'd still only have 16,000. And whether that's that or real estate. In 2020, I bought this property. It was worth $560,000. Today, it's worth about $750,000. I took an $80,000 down payment, financed the rest at 2.65, and now I've got another $250,000 in equity sitting, actually plus some. Because I got that out of fiat, it appreciated. Same with stocks. The list continues to go on. The point is, as a voter or as a human being, you got to get out of fiat. That's my opinion. Long-term vision, how do you manage? I stay foot on the gas. I stay invested. But right now, the only thing I'm doing different is I'm not investing new money. I'm storing capital on the side, which is fiat, and I'm waiting for the next year. I'm waiting for 2025 to see how it shakes up. All right, guys. I probably offended somebody today. So be it. But I probably compelled somebody today that they're not thinking wrong. I probably encouraged somebody today that your thoughts matter, and you're probably thinking the same shit that I'm thinking. Let's face it. You've probably been thinking about this same stuff. You probably realize all these same things. And so recognize that if you have a voice or you have a following, even if you don't, you have a voice, you can speak up, and you can realize that we don't have to be black and white. We don't have to be left or right. We don't have to be such a divided country. We can be common sense Americans, because that's what we are. We can be common sense people from the globe. Everybody around on this call is probably from Canada and the UK and Europe and Australia and you name it. My vote is for common sense, which, let's face it, in most countries don't exist. Canada, you too. They just don't. But what we can do is we can help our family. We can realize what we are up against. We can invest smartly. And that's what we can do. Appreciate it, guys. Have a great rest of your day. Over 200 of you joined me live today. I appreciate that. Make sure, if you guys haven't already, click that subscribe button. Why? Because then you'll get a notification when I go live. I'm going to try to do these multiple times a week. Turn on the notification bell. I'm also going to be posting some videos. Same thing there. So much fun. I love it, guys. Ryan, Cleve, Alexandra, who else? Julie, Hesser, Johnny, who else? Fred, Camelia, who else? Felicia, Sergio, Sam. To all of you guys, I appreciate you. Thank you so much. It was a lot of fun. Have a phenomenal weekend. We'll be back and talk soon, guys. Bye-bye.